Good afternoon and welcome to our fifth session of the day. If you experience any technical difficulties throughout the session, please go to the help desk in the top menu bar and use the chat live functionality to speak directly with our platform support. There will be a Q&A towards the end of the presentation, and we will also ask you to get involved in some poll questions throughout. You can engage in both activities via the Slido box on the right-hand side of your screen, by scanning the QR code you currently see on the presentation slide, or by going to slido.com and entering the reference number C179. I'll now hand over to our speaker for this session, Dean Wickens. Dean, over to you.
Thank you very much. Firstly, thank you so much for giving me an opportunity to speak about regulatory changes in 2020 and beyond. It's a real pleasure to be able to present to you all, albeit virtually. In terms of learning objectives for this session, by the end of this session, you will be able to understand the impact of COVID-19 on the regulatory landscape, explain key trends in insurance regulation, and understand some of the regulations that are impacting cover holders in some of our key markets in the US, Canada, and Australia. I guess one of the starting points might be, why should yourselves as auditors be interested in regulatory change? Well, I think the answer to that is frequently these regulatory changes impact cover holders, either directly or indirectly, and as such may have implications for yourself when you're conducting your audits and making sure that cover holders are being mindful and observant of local regulations and requirements. In terms of this presentation, I've split it into two. In the first part of the presentation, I'm going to basically talk about the regulatory changes expected. First, I'm going to talk about regulatory changes that were expected in 2020. And spoiler alert, it will come as no surprise that the regulatory agenda in 2020 was largely overtaken by COVID-19. And then in the second part of the presentation, rather like a kind of mystic, sort of regulatory mystic Meg, I will attempt some predictions around what we might see in the way of regulatory change this year and in coming years. I'll leave a few time at the end for any questions there might be. By way of background, I work in the International Regulatory Affairs team, and I am responsible for the Lloyd's International Trading Advice team, which is known to the market as ALITA. ALITA handles queries from across the market, and obviously as Lloyd's has an extensive range of global trading rights, the ALITA team receives multiple inquiries daily, thousands actually in the course of the year. And many of these queries are from cover holders who are seeking to understand what they can write through Lloyd's and how to do so in a compliant fashion. As such, I imagine that when you are conducting your audits, you may have seen instances of correspondence between the cover holders and the ALITA team. Before I start this presentation, just very briefly to make the point that I will be talking about regulatory changes in the insurance industry. And secondly, I'm going to be talking about specific countries generally, talking about general regulatory change rather than talking about specific countries. And the reason for that is, given Lloyd's range of trading rights, there's not enough time in this session, or frankly, probably even in this conference, to talk about all the regulatory change that's happening across all those different territories. That said, I know that many of you auditing will be doing so for cover holders in some of Lloyd's largest markets. So there's a couple of slides at the end that talk specifically about some of the regulatory changes that are going on currently in the US, Canada and Australia, which I think will be of relevance to yourselves as auditors of those cover holders. So let's make a start. I think it's helpful to think about, when you're talking about regulatory change, to maybe think about what the regulatory expectations were at the beginning of last year. And if you cast your mind back 15 months or so, you might recognise some of the following kind of regulatory expectations. I've put 4 down here, there's probably more. But firstly, I think there was a sense that there may be less prudential regulatory form. And what I mean by that is that over the last decade, there's been a number of countries and regulators that have introduced some new prudential regimes. Frequently, these regimes have included some sort of risk-based capital requirement, which is sought to align capital to the licensee's risk profile. And many of these prudential reforms have now been, over the last sort of decade or so, largely complete. And as such, I think at the beginning of last year, there was a view, maybe more of a hope, that the insurance industry might see less of a focus on significant prudential regulation and more, I think, regulators tweaking or refining their own prudential frameworks to better reflect the requirements in their respective markets. That's not to say that there wouldn't be change, but where I do think there was change, it would be based around, and moving on to the second point, regulation based on country-specific issues. So there would be change expected last year, but it was driven or expected to be driven by domestic issues or concerns. And examples of this might be in Australia, that was expected to implement changes following the recommendations of the Financial Services Royal Commission. And indeed, here in the UK, where if you cast your mind back at the beginning of last year, there was a lot of focus around the future trade deal between the UK and the EU and what that might mean for the regulation of financial services. Thirdly, I think we can point to an expectation of regulators starting to look at increased focus on non-financial risks. So moving away from that focus on financial risks and starting to look to other areas such as conduct and climate risk. And then the fourth expectation I want to briefly mention was around technology. I think insurance regulation is expected to be challenged and would need to consider the pace and scale of change caused by disruption and disruptors, such as the development and growth in insurtech. Interestingly, I think the other side from the technology is the opportunity, and we've certainly seen regulators around the world increasingly using and looking to use technology to help them with their regulation. This is the development of what's been termed Regtech. As it was, all of these expectations at the beginning of last year were largely overtaken by COVID-19. As soon as COVID struck, regulators sought to, I think, understand the impact both on the insurance market, but also to try and protect their policyholders. So looking at it, first of all, from a kind of an insurer perspective, I think we've seen four distinct phases. In the first phase, when COVID immediately struck, regulators all around the world were really focused on understanding and assessing the operational impact of COVID. So, certainly Lloyd's, we were facing questions around our business continuity plans, were offices remaining open, how was technology holding up to remote working, and how were policyholder queries or complaints being handled, and were customers getting the service that they would expect. In the second phase, regulators started to look at, I think, at solvency from two separate angles. First of all, and remember, this is at a time when stock markets and investment returns took a large drop. Regulators were seeking to understand what was the impact on the asset side, on the balance sheet. What did the diminution in the value of these assets mean from a solvency point of view? And then they started to look towards the liabilities to understand what happened or what was happening and what claims were expected to be paid out as a result of COVID. And this occurred when, I think, when stock markets were starting to improve, and the focus then switched to the liability side. And then finally, I think regulators started to look increasingly at specific issues or concerns that had arisen as a result of COVID. A good example of this is some of the attention that's paid to particular classes of business. For example, there's been a lot of regulatory scrutiny around business interruption and how business interruption should respond to COVID-19 losses. Regulators have also sought to protect their policyholders, and regulators around the world have issued multiple bulletins and notices which have made very clear their expectations of how they expect industry to deal with COVID-19 issues. Where COVID coverage has been in dispute, insurance regulators have looked for clarification. Here in the UK, for example, the Financial Conduct Authority took the unprecedented step of actually taking a BI test case to court to provide some clarity. I think that was the first time that's been done by a regulator anywhere. In other instances, maybe the regulator hasn't taken the case to court, but the regulator has closely monitored the implications of legal cases and then used this legal cases to inform its own view or its own position. We've certainly seen cases of that recently, the FBD decision in Ireland. We saw it in Australia regarding the repealed Quarantine Act. And we've also seen it in South Africa as well. Maybe this is a good time to come to the first question. I mentioned that we here at Lloyd's have received many bulletins or notices regarding COVID-19. And the first poll question is approximately how many regulatory notices or bulletins regarding COVID-19 has Lloyd's communicated since March last year?
Great, thanks, Dean. So just remind you can answer this on the right-hand side or going to slido.com and entering C179. You will have 60 seconds to answer it once you have joined and the poll is live. So we'll just wait for the people to join and then we will open it up. Okay, the question's live, so get your answers in and see what comes in. Got 30 seconds to go to get those answers in and then we will see which one of you got it right. Okay, so Dean, looks like the most popular answer was 150.
Okay.
Have it correct?
That was not the correct answer. It's approximately, because the number continues to increase. We continue to receive notices or bulletins. But last time I checked, it was just over 200 bulletins or notices have been received. Many of these are actually relate to the US, where various states have issued notices, often relating to moratoriums or cancellations of cover, or around premium payments, non-renewals and the like. But the correct answer was just over 200. And each of those Lloyd's has had to communicate to its market. For example, these have been issued through LETA e-alerts. They've also been, and the notices have also been embedded into Crystal as well. So our cover holders always have the most, the recent information as far as these notices or bulletins are concerned. So obviously this activity around COVID kind of overtook what was originally being planned by regulators. And the result of this was, regulators needed to change their plans. And we saw that communicated by various of our regulators around the world as they had to change their activities and turn their attention onto COVID-19. I put some examples up here. On the left-hand side is a communication by the Prudential Regulation Authority here in the UK, talking about them having to reassess their plans for the coming year and reprioritise their work. The Australian regulator, APRA, very clearly talks about having to suspend the majority of its planned policy and supervision initiatives in response to the impact of COVID-19. And also we saw in Canada, the Canadian regulator, OSFI, announcing that it would have to review its supervisory and regulatory priorities to align with current conditions. And that was, there were 3 examples, but we saw that by many regulators. Remember, this was the activities that were conducted by regulators around COVID wasn't planned, wasn't anticipated at the beginning of last year, but had to be considered. So moving on to regulatory expectations for this year and going forward, what do we expect? I think firstly, obviously the activities originally scheduled for last year that were parked will appear back on the regulatory agenda and likely with increased urgency. And I've touched on these previously. I think we can also expect to see issues or continued focus on some of the emerging key global issues. The first of those I've highlighted is environmental, social and governance issues. These are now really important for regulators around the world. Things like the adverse impact of climate change has been an area where there's been a lot of supervisory discussion. And to kind of illustrate the point around how important ESG is now from a regulatory perspective, I thought I'd share a few simple examples. So firstly, here in the UK, the Prudential Regulatory Authority has set out its expectations for how firms should identify and address climate risks. The PRA has established the Climate Financial Risk Forum, which it co-chairs with the Financial Conduct Authority, and that's intended to build capacity and share best practice across industry. Lloyd itself is actually a member of this Climate Financial Risk Forum. Elsewhere in Europe, we've seen the European Commission looking to incorporate sustainability into its Solvency II directive, which is due in 2021. In the US, we've seen the National Association of Insurance Commissioners setting up a task force focused on climate and resiliency. Individual states are doing their own things. For example, the California Department of Insurance is seeking to develop a sustainable insurance roadmap to confront California's climate risks. In Dubai, in the Middle East, where Lloyd has an office, we've seen the Dubai regulator adopting the guiding principles for sustainable finance, and we'll be encouraging firms operating in the DIFC, including Lloyd's cover holders, to implement sustainable strategies. I also think this year we're going to see regulators place increased scrutiny on non-financial risks, and by this I'm referring to operational resilience, culture and accountability. A number of Lloyd's sort of key regulators, including APRA and OSFI, so the Australian and Canadian regulators, have signposted a greater need for better management of non-financial risks and have raised their concerns that non-financial risks do have the possibility of generating prudential risks. There'll also be, under this area, I think, a continued focus on trying to ensure fair outcomes for and the treatment of consumers, including around claims and complaints handling, which I think will be relevant from a cover holder and also a cover holder audit perspective. Regulators, as part of this kind of non-financial risk area, are also looking at areas such as incentivisation, remuneration and decision-making by insurance licensees. And then the final kind of key global issue, I think, where we expect to see regulatory attention is around digital cyber and data growth. And this is largely driven by a greater adoption of digital technology, and regulators looking to carefully understand the risks posed by technology to both firms and also to customers. I think whilst we're all hopeful that we are starting to see signs of positive signs as far as COVID's concerned, I do think that it's likely that certainly throughout this year and possibly even into next, regulators around the world will continue to deal with the legacy issues arising from COVID. For example, I think it's likely that many of the regulatory requirements which were issued, those bulletins and notices I referred to earlier, they will continue for the time being. I also think regulators are going to be looking really hard at policy wordings, particularly around coverage and exclusions. So, it's absolutely clear which policies respond to pandemic type events and by how much. And finally, I think bearing in mind how heavily tested business continuity plans have been, I think we will see regulators continue to put lots of focus on reporting around operational resilience. The need for well-considered business continuity plans has become really paramount. I said at the beginning I'd spend a little bit of time just briefly mentioning some of the regulatory developments that Lloyd is expected to see in some of the US states where we have key cover holders, and presumably I'm sure you have cover holders that you audit. So first of all, starting with the US, and I'm going to go quite quickly through these because I know there's been separate presenters on each of these. But certainly the US states, as I mentioned, have been amongst the most active in terms of introducing COVID-19 guidance. Most US state Department of Insurances have issued some form of guidance on COVID, for example, requesting or mandating premium grace periods, moratoria on the cancellation or non-renewal, and even premium credits in lines where the pandemic restrictions have reduced exposure. Whilst in many instances this guidance has now expired, there are a handful of states where guidance remains in place. And even where guidance has expired, I think regulatory expectations are that customers will be treated fairly and given flexible terms where possible. Consequently, I think it's really important for cover holders that are conducting business in these states to ensure that all cancellation and non-renewal requirements are followed. Many state departments of insurance have also asked insurers to take extra care to avoid cancelling and non-renewal of policies if possible. So cover holders really need to be aware of the heightened sensitivity in these areas. There were various attempts last year to basically apply retroactive legislation, compelling insurers to pay COVID-19 related BI claims. But none of these were successful. Several states have looked to introduce retroactive BI legislation in the 2021 legislative session. But I think Lloyd's belief is that there's a relatively low chance that these will be enacted successfully. However, we will be watching this issue very carefully. In addition, various states are also considering prospective business interruption proposals. And what I mean by that is requiring BI insurers to cover pandemic-related business closures going forward. So cover holders that are writing this type of coverage should be aware of these new requirements or restrictions which may be forthcoming. And also on the reinsurance side, some states have publicly stated that they will not accept any new virus or pandemic exclusions. And I understand anecdotally that many states are taking that position and refusing to approve filings for admitted insurers. Lloyd's expects also, moving to the second point, to see continued regulatory focus on natural catastrophes, a high volume of US Nat Cats in 2020, and as such, the market was required to respond to numerous state-level claim data calls. It's likely, I think, that these data requests will only continue to grow. I know yesterday the Texas Commissioner announced a data call with respect to the recent Texas windstorm and also blackouts. And often this data has to come from cover holders. So cover holders in these areas should be really mindful about the data elements required. With respect to post-catastrophe moratoria on cancellations and non-renewal, we expect that this is a trend that will continue. And cover holders need to be aware of this for two reasons. First, so that they can consider the potential when setting the term and anniversary dates on their policies. So as a simple example, in coastal states with hurricane exposures, it might be beneficial to set the anniversary date of the policy outside of the hurricane season, so as to avoid a situation where maybe the underwriter wishes to not renew the risk, but is unable as the policy is covered by the moratorium on non-renewal. And cover holders also need to be very attentive to ensuring that cancellation and non-renewal notice requirements are followed. In many states, if the notice is not followed within a certain period of time, the policy must be extended or even renewed for the full term. Therefore, I think it's vital to ensure that if a notice is sent, it's therefore vital that a notice is sent if there's any question about whether the policy will be renewed. Finally, with respect to US licensed business, obviously in July last year, Lloyd's announced that it would be relinquishing its 3 US admitted licenses in Illinois, Kentucky, and the US Virgin Islands. As such, cover holders that are involved in writing admitted business need to be mindful of the appropriate timelines and make sure that non-renewal notices are sent in good time. Briefly on Canada, I think yesterday's Q&A session included a Lloyd's Canada automobile specialist. So all I'm going to say around Canada from a regulatory perspective is that the Lloyd's Canada motor automobile portfolio has grown significantly in the past few years. And this is also a class which is probably the most regulated line of business in Canada. It's subject to probably the most change. And it's also, as I say, regulators are just extremely interested in it. Understandably, when you're conducting audits, the audit focus tends to be on the larger or more complex binding authorities. And as such, automobile binders are not typically selected for audit. But I think as this class increases and as the scrutiny increases, that might be something that needs to be looked at going forward. And then finally, moving to Australia, two really, main focus around Australia is around the new General Insurance Code of Practice, which comes into focus this year. Lloyd's has already been in contact with its Australian cover holders to check that they've implemented the requirements for vulnerable customers. And Lloyd's is also proactively engaging with cover holders to ensure they have sufficient compliance frameworks in place and are implementing the new requirements under this legislation. And then briefly to mention the Financial Sector Reform Act 2020, which was given royal assent in December last year. There's many provisions in that cover holders need to be aware of, but the relevance of that depends on the class of business that is being written. Final poll question before closing. Hopefully, following this session, you now understand some of the regulatory changes we saw last year and also the regulatory changes that we're seeing currently and going forward. So the poll question is, to close this, are you expecting the time your cover holders spend on complying in regulatory requirements in 2021 to increase, decrease, or not change?
Thank you, Dean. So just reminding you, you can access this by the screen on the right-hand side or going to slido.com and entering C179. Let those numbers come in and then I'll let you know what is the most popular answer. Okay, we've got a very strong lead on increase. 82% of attendees have voted for increase.
Yeah, I think all the evidence points to regulation increasing in this year. I think COVID has shone a light on areas that maybe hadn't been given as much regulatory attention in the past. So I certainly think the 82% or so who went with increase, I'm certainly in that camp. That closes my presentation. I'd be happy to take any questions.
Great, yeah, we've got some coming in already. So the first question is, if the courts in the US rule COVID-19 related claims must be paid, does Lloyd's have solvency concerns?
In answer to that question, I think Lloyd's has done a lot of work in terms of its exposure to COVID, not just in the US, but we continue to monitor and look at our exposures all around the world. The answer to that would be no. I think Lloyd's is if you look on Lloyds.com, you'll see lots of statements by Lloyd's, and also in its report and accounts as well regarding solvency and COVID exposure.
Great, thank you. Next question. Would any regulations regarding BI in the US apply to surplus lines business, which is typically exempt from form and rate regulation?
That's a really good question, and I don't know the answer to it. If the person that inquired that could please send that query to events@lloyds.com, and we'll go back to the inquiry directly with that. I'm sorry, I don't know the answer to that.
That's fine. Yeah, if you just send the question to events@lloyds.com, then we will pass it on. Thank you. So regarding to BCPs, what has been the main areas of deficiency you have found?
I'm not able to talk to the kind of the Lloyd's business continuity plan. So that would be the one that, from a Lloyd's perspective, has been the one that's regulators have looked at. In terms of our cover holders and what regulators have seen when they've reviewed the business continuity plans for those cover holders, again, I think it will vary, and it will vary by country, and I think it also vary by regulator as well. It's difficult to say, bearing in mind the vast number of cover holders, the differences in those business continuity plans, and the difference, I think some of the different areas of focus that regulators will look at. As examples, things such as remote working. I think many business continuity plans have talked to the importance of remote working, but have never really had the opportunity or the need, frankly, to implement the business continuity plan that saw offices being shut completely and then people having to work remotely at home. I think it's really difficult to say, and I'm not aware of any regulators issuing their results in terms of what they found as a result of any tests that they've done on business continuity plans.
Great, thank you, Dean. Next question. If forced into renewal to fund US catastrophe or COVID claims, can premium be increased to match the increased exposure?
I think individual states have issued guidance on that, and I think that guidance is actually, in many instances, on crystal under the appropriate state content. Again, if the person who's raised that query, which is a good one, can send an email to events@lloyds.com, then I can look into that. I'd probably have a conversation with our US colleagues who are very familiar and much closer to this than I am, and we can come back with an answer to that.
Great, thank you. Regarding complaints, do you have oversight of Lloyd's complaints department and the professional expertise of the persons handling complaints?
Sorry, I'm not quite clear with the question. Is the question the expertise of the persons in cover holders dealing with complaints?
I believe so. If the person who wrote it wanted to give us a little bit more information, then we could pass that on to Dean. Just a moment, it just says the professional expertise of the persons handling complaints. If they want to provide just a little bit more context, then we can ask that again. For now, we'll just move on to the next question. Can auditors access the LITA country reports?
I don't believe they can, but I can look into that. There's various content on Crystal, some of which is open, free access to everyone. Some of it is locked down on there. I'd need to look to see, but I can take that away as an action and have a look at that.
Thank you, Dean. I'm just seeing which ones people are voting for them, so they're moving up and down. Do you foresee the FCA generally becoming more interventionist in the future on what they feel insurances should cover?
I mean, it's difficult for me to, so speaking personally, rather than wearing a Lloyd's capacity, and I should say at the outset, obviously, responsible for international regulatory affairs. So we have a team that deals specifically with the PRA. I've not seen from discussions with colleagues who are closer to the PRA that actually happening. That's not to say that I don't think, I think regulators are all following COVID, are looking very closely at the types of insurances that are required and how they should be, for example, sold. But I've not seen any evidence to suggest that the PRA has become more sort of interventionist in that area. But I'd probably have to defer that to one of my colleagues who's closer to the PRA.
Thanks, Dean. Is it possible for auditors to receive notifications regarding regulatory changes?
Not sure if it's possible to be notified by email, but all regulatory changes on Crystal are communicated as a what's new. So if an auditor looks on Crystal, they will be able to see what new content or where changes have been made. So I don't think necessarily it's possible to send an email saying, for example, that there are regulatory changes, but you should be able to see relatively easily where there have been changes on Crystal.
Excellent. Regarding customer care scrutiny for claims in particular, what changes does LITA envision for conflicts of interest around DCAs owned by law firms and brokers, etc.?
That would probably be a question. If the inquirer for that one could just send the inquiry on to events@lloyds.com. I don't know the answer to that.
Okay, that's fine. We have one last question coming through at the moment. Do you monitor the effects of non-insurance regulation, such as the Illinois Biometric Privacy Information Act, as other states may take up similar legislation?
It's going to, again, there's probably one that is best for the US team. So again, please send that email in, and we can look into the specifics of that. But I'm not actually familiar with that legislation.
That's great. So yeah, so any that we didn't answer, or if you have any follow-up comments on some that we did, if you just send them to events@lloyds.com, then we can get back to you on those. Just going to give it another minute, see if we get any more questions come in. Okay, so we've got a bit more clarity around the earlier oversight question. It was more who is responsible for the performance of the Lloyd's complaints department.
Who was responsible for it? The Lloyd's complaints department is obviously a team within that. If somebody has any, or the person has any comments or observations around how complaints are being dealt with at Lloyd's, then again, probably best to send those in, and we can pick those up separately.
Thanks, team. We haven't had any more questions come in at the moment. If you do have them, as we say, please do email events@lloyds.com and we will follow up with you afterwards. Dean, is there any further comments that you'd like to add?
No, just to thank everyone for their time and for listening. I know regulation is not always the most exciting of topics, so I really appreciate everyone listening through. I hope you learned something. And again, if anyone's got any questions after this, then please just reach out through the email events@lloyds.com, and I'll make sure that we come back with a response.